Hello and welcome to another Macro Monday. My name's James Brodie and today I'm joined again by Harry Nedeljkovic and also our Group Head of Research, Harry Tchilinguirian. Today I'll be discussing last week's weaker than expected US economic data, but then the more hawkish Federal Reserve Central Bank.
Hello, I'll be going into a bit about the French election that's coming up, in addition to Argentina and essentially their economic situation.
Hello. Well, through our journey through the various macroeconomic indicators, we're going to do a little stop on China, and I think that's really important in terms of how that may come to impact oil demand. That, alongside the perhaps discrepancy in Fed policy and implications for the dollar and financial headwinds for oil, I think we're going to have a pretty good number of items to discuss and exchange views on.
Before I pass over to the guests, I'll just briefly run through the US data last week. The inflation data, both CPI and PPI, came in lower than expected. This was good news for the Fed. CPI fell to 3.3% year on year, and PPI actually came in negative, down 0.2% month on month. Also in the week, we had some weaker than expected jobs data. Jobless claims jumped and also continuing claims jumped. And then the week closed with particularly weak consumer sentiment survey, which fell to a 7-month low of 65.6 versus expectations of 72.1. The big unexpected event of the week, though, was the Federal Reserve came in more hawkishly than expected. The previous Fed meeting 6 weeks ago, the Fed dot plot, which is where the Fed members show their expectations of where the Fed funds rate will be at year end. Previously, 6 weeks ago, they had 3 cuts. The median of last week's meeting came in at just 1 cut. The market took this as hawkish, yields suddenly jumped, but if you look further into detail, the breakdown showed less consensus. 2 Fed members were expecting no cuts this year, 7 expecting 1 cut, and 8 expecting 2 cuts. What's probably more surprising to the market was the Fed sees the unemployment rate remaining at 4% until year end. It's recently risen from 3.4 to 4%, and the Fed expects it to stay there by year end. At the end of the week, though, the bond market was disagreeing with the Fed and is now pricing 49 basis points of cuts. Harry, what are your thoughts on the US economy and the Federal Reserve in the months ahead?
Well, I think the interesting part is definitely, as you highlighted, a more hawkish tone by the Fed, at least when it comes to the median dot plot. So we're looking at implied cuts of only 1 this year. The interesting bit is that they added an extra cut for 2025, but I mean, if we say focusing on the short term, we're looking at something here that is definitely, in terms of how interest rate differentials are going to go and how that's going to impact the dollar, something that could prove to be a headwind for oil markets from the financial point of view. So I think in my view, there was obviously a lot of expectation for Fed easing earlier this year. That expectation was eventually downplayed a little bit. But at least, especially when you listen to Fed Chair Powell in the conference, I don't get personally the sense that the Fed is going to move until that 2% inflation print really shows up. So that in of itself for me is relatively bearish the U.S. economy, and then at the same time pretty bullish dollar on the interest rate differentials.
So you think the Fed will be forced to stay higher for longer?
Yeah, and I think they want to. At the end of the day, you and I were talking a little bit about this, is this sort of unicorn, which is a soft landing. Right now the unemployment rate in the U.S. has inched up to 4%. The Fed, as you said, is keeping the target at 4%. I'm thinking, as long as we're at those levels, they could continue their efforts in terms of staying put on the interest rate front. They achieved one of their targets, more or less full employment. The other target, inflation, has to be achieved before they start budging. But on the other hand, as we know, other central banks are looking the other way, with potential banks such as the Bank of England this week, or even the Swiss bank, well, even though expected to remain on hold, pull a surprise, follow in the footsteps of the ECB.
Absolutely. While we're talking about that, actually, the economic data, let's move on to, actually, we have the 2s10s bond spread. How do you interpret this?
Again, back to that idea of soft landing. The first time the 2s10s were inverted, everyone was looking for a recession. The level of inversion has diminished, obviously, from the previously heavily backwardated structure. But, following the Fed's meeting, we look at the 2s10s gaining a little bit, or the 2s gaining on the 10s. We still have this sort of recessionary outlook, at least priced in the bond market. And so I don't think the market is thinking the U.S. is out of the woods just yet.
And we've been inverted for over 2 years now.
Yes, amazing.
Why haven't we had the recession? Is it stimulus, fiscal stimulus?
There's obviously a lot of spending, as we know. The U.S. administration has gone on a spending binge, and that obviously translated into some of the inflationary pressures. But then again, we could ask ourselves, when we look at the ISM manufacturing numbers in terms of PMI data, we had a string of sub-50 ISMs manufacturing, and yet we did not have a recession. Very, very curious. I think this is probably the first time that we had such a string of weak readings with no economic crash, if you will, that ensued.
Absolutely. It's a service sector that's continuing to show strength.
Yes, absolutely.
Next, we'll move to France. Of course, we have the elections taking place. Last week, French bonds tumbled. In fact, the spread between French and German 10-year bonds has moved to 7-year highs. Harry, what's going on exactly in the French elections?
So there's been a real, you could argue almost a vote of no confidence in who markets believe will be the next prime minister or will be the largest party in the legislative elections in, June the 30th will be the first round, and then July the 7th will be the second round. Macron and his governing party are forecasted to do extremely poorly. So currently they're polling around 18%. Their biggest rivals, or especially who the media likes to portray as their biggest rivals, the Rassemblement National, they're polling between 30 and 35%. And similar to virtually all major opposition parties in France, public spending's forecast to keep increasing. So Macron is sort of seen as the more restrictive in terms of spending, in terms of who's likely to do well at the elections. And the biggest competitors, so the Rassemblement National and the new left-wing coalition, which formed last week, both polling around 30%, and both essentially markets believe that they're going to increase the deficit by quite a considerable amount.
Yeah, it's extremely interesting because you have the polar opposites of extremes gaining most of the vote. And I was talking with Harry a little bit earlier today, and we're trying to couch various scenarios in which you would get a Rassemblement National government led by Mr. Bardella. And so here, I think what the tricky bit is going to be how the center-right vote eventually evolves, whether it goes towards the far right or where it decides to stay put with Macron's current party or representation, which is called Ensemble. So there is a possibility, there is a path for a far-right government. It is plausible, especially if you get that center-right, Les Républicains, at least splitting perhaps, and some of those seats going to reinforce what is expected to be a pretty big representation when it comes to the Rassemblement National. At the end of the day, the French elections then are going to produce a new government. Well, when it comes to foreign policy, defense matters, that still remains a prerogative of the president, and there's absolutely no reason for Macron to resign should his party lose, as is expected, their majority in parliament.
But we'll probably likely see some more volatility in the weeks ahead.
Yeah, sure, and no doubt, as the polls will obviously change. That center ground is a shifting sand. And so whether it starts leaning a little bit left or a little bit right, that could sort of, change the picture a little bit when it comes to what kind of majority either side could develop, as Harry was saying, a new left-wing front versus the Rassemblement National. But that middle ground, the swing vote, if you will, that's going to be really interesting.
And it's not just the bond market that's affected by this. The CAC index had its biggest weekly fall since 2022 and is now down on the year. If we move on to China, we had some Chinese data out on Friday and over the weekend. Retail sales beat expectations, up 3.7%, but industrial production up 5.6% year on year was actually lower than expected. But what caught my eye more was that the property prices fell. It was the largest monthly fall in over 13 years, and also M1 money supply had its largest drop since January 2000. We have the chart of the M1 here. Any thoughts? How was this going to affect the global economy and also oil demand, of course?
Well, if we're going to start off with, oil demand, I mean, in addition to these numbers, we could also couch them in the context of the inflation figures that came out of China. CPI, positive year on year, but relatively weak contraction in the PPI index, or the producer price index. We're looking at a deflationary situation in China. And when you have industrial output, still posting a solid print in excess of 5%, but below expectations of in excess of 6%, you have that deceleration in terms of industrial production that is also accompanied, as you highlighted, by a weak property market. The property market, China's exports and industry are key to its GDP growth. So that then leads us to question as to there is a consensus that oil demand growth in China is going to be circa 500 kbd to 600 kbd. Some see a little bit higher, but most pundits right now are looking at oil demand growth around 1 barrels per day year on year for 2024, maybe up to 1.5. OPEC is off in its corner at in excess of 2 million barrels per day. But nonetheless, if everybody's forecast has global oil demand growth concentrated in Asia, and the biggest chunk of that Asian oil demand growth is indeed in China. So you start getting these kind of red flags. You have to, even mid-year, you have to start really wondering whether or not some of the forecasts that saw Chinese economies growing in excess of 5% are going to be trimmed down back to the 5% target. And that could shave, obviously, a few KBDs off the growth picture and make for a weaker second half. And by extension, one could draw conclusions or maybe scenarios around what OPEC will eventually do with the barrels that it has withdrawn from the market. That conditionality that they put out saying we'll return the barrels in Q4 if conditions are right. If China proves to be weaker than expected, then perhaps those barrels will have to stay put.
So the risk is for demand, the downside? Clearly.
Downside risk to demand growth, yes. Yeah.
Just to add to that point, Harry, I was reading something last week that went into essentially Chinese refineries and their spare capacity. So essentially that's been increasing as a sign of weakening demand.
Well, yeah. There's one aspect of the increasing capacity is as related to capacity coming online, new capacity that's built. But clearly the latest data that we got off the Bloomberg terminal estimating the Chinese crude runs in May dipping to a 14.3 million barrel a day low. Yes, we are in a planned refinery maintenance season, but one has to really question, of course, whether or not, if demand is not there, that China is going to be actually able to run this capacity. My view is that, if domestic demand is indeed weak, and they do want to run refinery capacity to sort of bolster GDP at the end, and the value added that the sector contributes to GDP is non-negligible. If they want to do that, then they're going to have to actually come out and afford Chinese oil companies with larger product export quotas. So interestingly enough, as we were talking earlier, China being central, it's not just in terms of oil demand growth, but if they run those refineries and they don't have the domestic demand, they're going to have to push more product onto the market. So this is where you could see, more diesel exports, for example. And when it looks to the distillate picture in Asia and pricing in Singapore, is there downside to gas oil cracks by year end? Just simply as a result of when these refiners come out of maintenance, they make product, not enough domestic demand. Sure, there is storage to buffer against that, but then we're looking at the need to do more exports. And I think quotas issued by the Chinese government relative to clean products will have to be modified accordingly.
Okay, interesting. And if we move on to UK data, last week unemployment jumped to 4.4%, with 139,000 jobs lost over 3 months. It was weak data across the board. Industrial production fell 0.4% month on month. UK manufacturing fell 1.4% month on month. What's keeping the central bank from cutting rates is wage growth is still positive. But now we see UK mortgage arrears rise to the highest level since 2016. We have the Bank of England this week. There's 44 basis points of cuts priced by the OAS market. The market's not expecting a move till the third quarter at the earliest. What's the chances we see a surprise in the markets? From the Bank of England or the SNB? The ECB have cut, the Bank of Canada have cut.
Personally, I think the Swiss are going to stay put, and there's a greater chance of that. Bank of England, it's a tricky question because, any policy change that's unexpected, especially in the course of an electoral cycle, where, they're, interestingly enough, France and the UK are having general elections more or less at the same time. So will the Bank of England want to budge on policy during an electoral cycle? Maybe wants to keep its neutrality and stay put until such time that political events are passed, as possible. If the data is indeed very, weak in the UK and inflation has come in, maybe they budge. But I'm leaning more on the steady as she goes approach.
Yep, central banks certainly don't like to surprise markets. When I used to trade the New Zealand OAS market, we used to have a call the week before the central bank meeting with the RBNZ to see what was priced into the markets and what we were expecting, because what they don't like to do is surprise the markets, because then the bond market typically overreacts. We also have the RBA this week. Again, nothing's expected there. Actually, if we look at the market pricing, the Federal Reserve, the market's expecting, I mentioned earlier, 2 cuts this year, or 49 basis points, an 80% chance they cut in September, and just 44 basis points from both the ECB and the Bank of England. And the hike that's being priced in Japan has now been cut down to just 19 basis points this year.
I was going to say that was an interesting one over the last week. So obviously they maintained their rate, but the yen is just weakening so aggressively. Who knows what's going to happen going forward?
Of course, the Bank of Japan had their meeting, and what they did, they discussed what they're going to do at the next meeting. The market didn't like that, and they said that the yen's weakening again.
I think the government's now spent, the Bank of Japan has now spent something like $60 billion on just
intervening. 2 interventions in the last month, and it's exactly at the same level.
As we know, central bank intervention can't last forever. So, if something doesn't change there, then, maybe the trend path for the Japanese yen is indeed a little bit lower.
Personally, I think we had the chart on before, the interest rate correlations, and I tend to think it's an interest rate play. But what you're seeing now is, again, the market started to price more the US central bank being higher for longer. Now it's starting to price the cuts again. So if it's straight interest rate correlations, then you'd expect to see dollar yen come down, but we'll see over time. Some headlines. We have some interesting trade wars escalating. EU's to impose additional tariffs on electric vehicle imports from China. A day later, China responded, China will take needed steps to counter EU action. Interesting piece of news I read last week. The average price of an electric vehicle produced in Europe is €46,000 versus just under €32,000 for an imported electric vehicle from China.
Quite impressive, isn't it? The Chinese government, as we know, has taken a sort of proactive approach when it comes to strategic sectors of the economy, whether that's tech or EVs. Obviously, they have a comparative advantage having rare earths at their minerals at their disposal. But this is certainly scary for the Europeans and scary for the Americans, where the overcapacity in China's EV industry is such that you have cars now that that are pricing at these levels. And if they were to enter the European or the US market, clearly there would be no competition. So scary thought for the US and Euro auto industry. And at the same time, one could argue, well, cheaper EVs, wouldn't that help accelerate, the energy transition at the end of the day? When you do compare the price of a traditional internal combustion engine car with that of an EV, the EV is still very expensive. So without government subsidies, we are actually seeing that demand drop off. But if China walks in and says, right, I have all these EVs, are half price, then the question of the future of whether it's the auto industry on the continent or across the pond, I think they're going to be asking themselves a lot of questions. Personally, I think whether it's the Europeans or even in the U.S., where the Biden administration has a relatively tough stance in terms of trade versus China. So China might just end up with a lot of cars on their hand that they can't sell to these markets.
You've got a lot of major automakers, especially Toyota. Well, Toyota essentially they didn't go down the full battery electric vehicle route. They went down the hybrid route. And it's really paid off. As demand started to flatten for battery electric vehicles in the Europe, US, given the massive excess costs associated with them, that sort of strategy is what's been paying off. So other companies that were far more focusing their strategy around pure electric vehicles, like I believe it was Ford, Stellantis, were also going down that route. They're starting to dial that back. So it'll be interesting to see how they amend that strategy in the next couple of quarters, next few years.
Yeah, I definitely saw the Toyota share price outperforming. An interesting point as well, I read that 100% of Europe's heavy rare earths are imported from China, and over 75% of Europe's soft rare earths are imported from China as well. And also we could talk about the impact it's going to have on government revenues, the petrol demand or decline in gasoline demand.
I think Harry raised a very interesting example with Toyota and the sale of hybrids, because right now, obviously governments in terms of incentives, they provide, as we know here in London, you could park for cheaper in central London. You don't have to pay the congestion charge if you have an EV or a hybrid, right? But until such point that we have ubiquitous charging, these hybrids often tend to run not necessarily on electricity, but on petrol or gasoline for our U.S. friends. And so at the end of the day, a growing share of sales of EV, if the consumer behavior or access to charging points is not different, then we end up having cars running on petrol rather than electricity. So in a way, that sort of creates a bit of I suppose, uncertainty as to the actual path of demand in general for hydrocarbons leveling off, and as far as gasoline, maybe there's with a greater share of hybrids, that leveling off may come later rather than sooner.
Oh, just to briefly add about the government point and reducing government revenues from gasoline going forward, be really interesting to see what governments seek to replace things like fuel duty taxes with. So, it's been floated around in London with Sadiq Khan with pay per mile. So I'm sure any government that wants to balance their books are going to be making sure they've got a watertight solution that fits both pure EVs, hybrids, and pure gas.
Being discussed actively in California as well, charging per mile. Another interesting chart here, Canadian bankruptcies rising sharply. Canada has 64 basis points of cuts priced in by the OAS market. That's a pretty conclusive chart there. I'll keep pushing on. Strong India economy. Indian stocks saw a monthly inflow of $4.2 billion in May, the largest in history. Definitely we're seeing some funds that are moving out of US stocks, saying that they're expensive, and certainly not shorting. Some are discussing that, but there's an active movement towards the Indian markets. Talking about the Nasdaq here, Nasdaq and the S&P last week made new all-time highs, but breadth continues to weaken. So the advanced, what we have here is the chart. The blue line is the NASDAQ Composite Index. The red line is the NASDAQ Advanced Decline line. As you can see now, there's far more stocks declining than advancing. This shows weak breadth. It shows that the market's being driven by a few key names, the Nvidias amongst others. Gentlemen, either of you think the market's overvalued? Would you be buying here, or no position, or are these levels to short?
That's a very interesting question, James. As you said, I think the key thing is that the market, not just the Nasdaq, but even the S&P, is carried by a few big names. And right now, if you think about NVIDIA, you think about Apple launching Apple Intelligence, the whole AI craze, is supporting and having obviously the index itself. But if you think of the likes of NVIDIA, right, these chips have to be going into computers, right? Even saw support for Dell Computer as sort of spillover effect of this, let's call it this enthusiasm. But it is a story that the market continues to buy, I believe, in terms of AI, which is profiting, a few large names that hold the index. But as the advanced decline indicator says, well, there are more stocks now that are retracing. But if the heavyweights are still there and progressing, then maybe we have a leveling off when it comes to equity markets. This in a context where the Fed has signaled a hawkish bias. So how much more really, I think, from a sort of equity market perspective is going to depend on future surprises in earnings. If these sort of meet their earnings target or thereabouts, the upside is perhaps a little bit limited. And then after that, I guess we'd probably have to examine whether the PE ratios of some of these larger caps that are boosting the market appear stretched or not. This hasn't prevented people from buying stocks with stretched PEs, but at the end of the day, I'd like to look at it as in terms of the asset class, because pre-quantitative easing, so pre-Bernanke, oil used to be quite decorrelated with equity markets. And with the inception of quantitative easing, and we've had that correlation turn into a positive one, so we now are speaking in the same breath when we talk about risk assets, about equities, we talk about oil, and there is a positive correlation in daily returns between the two. It's not always, of a constant magnitude, but it is certainly there. So if we get like sell-offs in equity markets as a result of a correction where people see things as being overvalued, you still have that knock-on effect that could hit oil as well, right? So interesting. We're still at the highs. I don't know if a trader would tell you, well, the risk reward now is more limited than what it was, 5-6 weeks ago. Maybe it's too late to jump on the bandwagon. I don't know. But
for now, it is still trending higher. And I should clarify, the people that are shorting are doing it via options, so they can clarify that exactly what their downside is by buying puts. Argentina, Harry.
Yeah. It's been a really interesting situation since Milei came to power in, I believe it was December, after their election. As a brief summary of him, he's generally known as a sort of firebrand, right-wing libertarian. Is very vocal about the fact he wants to destroy the role of the state, massively reduce it. He has his chainsaw to make those points. And obviously Argentina, an incredibly, well, I think you'd probably say underperforming economy. Generally, it's always known as a bit of an outlier. It's always known as a sort of case of how to not properly run an economy. They're the IMF's biggest debtor consistently. But they've been running a subsidy for the past 4 months. So they hadn't run a quarterly subsidy for the last 16 years until he came to power. But the big sort of story in the last week was inflation. So inflation's been absolutely skyrocketing, but finally it's come down year on year. It's still at about 276%, so nothing to get excited about. But the rate at which it's decreasing is decreasing massively. Essentially, it's come with a lot of protests, but he's finally managed to get a bill passed in the Senate, which was basically deemed unachievable before, given he only has 15% of the seats. But really an interesting one looking forward. They're their fortunes could really turn, especially with shale oil. So they're going to start monetizing that, and they could rival Chile in terms of copper production soon as well.
It's interesting. And should European politicians be taking more notice of what's taking place?
I mean, it's a hard one to take many examples from. But if you were a libertarian or a really a right winger looking to massively reduce the role of the state, I don't think there's many more prominent examples of what could happen. And obviously, we'll see what happens. The surplus has been declining month on month, so maybe that'll become a deficit again. But just a really interesting one.
Yeah, well, when it comes to emerging markets, although at least from an oil market perspective, the fate of Argentina is not necessarily what's going to move the needle, but I think more in terms of just general investor sentiment and how emerging markets are affected, you could probably have a reshuffling within the sector where you get more money headed to South Africa or even Turkey. I think James put, forth, between the chainsaw, the various hatchets. I mean, we had in the past some pretty, Chicago economic school type approaches in Chile, for example. The bottom line is going to be basically what kind of social pressure is the president going to face as he tries to enact those reforms. If the streets are going to be filled with people protesting, it may be a difficult one to push through. But nonetheless, from a more investor point of view, within that emerging market sector context, you could think about the various places you could go to in LATAM. Maybe you start shifting your LATAM exposure more to Brazil, more to Mexico. More generally speaking, you could maybe start looking further afield at Turkey, South Africa, and Asia. So, interesting one to follow. We'll see if those reforms get pushed through and what that means for the Argentinian economy.
Excellent. Headline that caught my eye last week: PIMCO warns of looming wave of US regional banking failures due to troubled commercial real estate loans. They said the real wave of distress is just starting. Chart of the week, I've brought up the 2-year bond yield. The yield broke below the rising trend line. It's also broken below the previous lows, broken below at 472. Certainly, trend following algorithms will be buying bonds here. It looks like the market's beginning to focus on the weaker US data. So buying bonds here with a yield at 472 with a stop loss at 485. Last week's trade of the week to short euro dollar at 107.60 is currently 60 pips in the profit. Key data this week: the US is off on Wednesday. US markets are closed. In the US, the data Tuesday, we have retail sales in industrial production, UK inflation data on Wednesday, and then Friday, US PMIs and UK and Canadian retail sales. Probably the bigger events: central bank meetings, again, no expected moves from the Reserve Bank of Australia, the Bank of England, and also the Swiss National Bank. What we do have that may move the markets: we have 16 Fed speeches and 13 ECB speakers this week. Any closing thoughts?
Well, I think generally speaking, I think the central bank policy is going to take front stage. One, we have official meetings, but two, we have a lot of speakers, whether it's in the US or in Europe. And just thinking about the US, it's going to be interesting to see how that sort of hawkish message sent by the dot plot is going to be carried forward or not in the commentary, because I have a suspicion that the markets may not want to believe the one rate cut. Maybe they're a little bit more optimistic and hoping that if inflation does come down faster, then this is what would open the path to 2 rate cuts by the end of the year. Personally, I'm not that optimistic. As we were talking about earlier, the Fed needs to reach that 2% target. And as it progresses, we'll have to keep a close eye on labor markets as to whether or not, that soft landing turns into something else. But I think, the commentary this week out of various Fed officials going to be interesting in how they, relay that message from the last FOMC.
I think as well, maybe not the data we've gone into much detail on, but given UK economic data coming up this week, obviously, apparently a huge reason that Rishi Sunak called the election when he did was because he believed that the economic data was favourable to the Conservatives. If that proves wrong and data goes even worse than we expect it might do, the Tories could be even more restricted in the election, and they might end up on even fewer seats than we expect.
Interesting. And one other piece of data, actually, I've not put on here. Typically, it's secondary data, but weekly jobless claims is going to become more prominent because it's a weekly update of US jobs, and it did jump quite aggressively last week.
I think you're noting as well in previous podcasts about the quality of labor market developments, because there's certainly the U.S. administration is leaning on the economy still being relatively resilient in the U.S. I mean, the forecast for GDP growth in 2024 is circa 2.5%, thereabouts. At 4% unemployment, that's not bad heading into an election. But then the question is, what is behind those numbers? And this is where the evolution in terms of labor markets in a context of a Fed wanting that solid 2% print before budging. That's really is going to be affecting sentiment and risk appetite, I think. So that sort of bond to equity, allocation bias may be shifting from one to the other. And with it, of course, for oil, if equities take a dive, then we're likely to see some kind of repercussion.
And just to clarify, when you talk about a 2% print with CPI, do you mean a 2.9? Would that be significant, or you want to see it right down at 2.0?
I want, but I think the Fed is in its communication has seen our target is 2.0 year on year. And
we still have a long way to go.
There was an interesting commentary that was sort of circulating about, when you look at interest rates, and especially when you try to look at what would be the neutral or what's called the natural rate of interest. So that's basically what's going to keep your inflation at target, but without tanking the economy. Maybe this neutral natural level of interest rate for the U.S. economy has risen, which effectively would mean that the current Fed funds rate is not as restrictive maybe as what people are currently thinking. Now, we haven't obviously looked into the whether there has been a shift in the natural neutral rate in the U.S. So, and I don't think many people are really arguing that. So that means that even with such commentary, I'm still thinking 2% is 2%.
It'd certainly be interesting. I personally think the data's getting a lot weaker. If looking at the economic surprise index, the data's coming in a lot weaker than expected. Maybe the bond market is going to try and force the Fed's hand.
It could, but as we all know, James, someone once said, don't fight the Fed.
We've learned that one the hard way. Excellent. Thanks very much for joining me. I'll actually be in Singapore next week, so I'll leave you in the capable hands of the two Harrys. It's going to be an interesting week. Good luck. Thank you.
Thank you.
Thank you.